This is part of a series of educational webinars we're doing this year. We've done a few already where we've brought in some experts on estate planning, on end-of-life planning, brought in a funeral home director. We've done some on cybersecurity and on Medicare. And at this point, we will be talking about 529s. And one of these days, I hope to be able to do this on May 29th. But for now, we got as close as we could without interrupting the holidays. So it'll be myself and my colleague Luke Trotochaud will be talking about the benefits of using a 529 for education savings, as well as for some other things like estate planning and tax planning. And so we'll go through that. There's also been several updates to 529s over the last few years. So some people may not be aware of some of the additional benefits. So we'll be covering that and some other alternatives to saving for college. So as I said, there's a few things we'll be covering, a basic overview of 529s and their benefits, which Luke will be spending some time covering. Also talking about, why are these so important? How has college become more expensive and how do people tend to pay for them? When you have money in a 529, how does it grow? And again, some alternatives to 529s for saving for college, as well as some of the updated rules in 2019, 23, and 2024. So without further ado, I will let Luke start explaining what is a 529.
Great. So there's all different types of ways to really save for college, but there's really only a few that would be, in our opinion, the most beneficial. James is going to go over later on in the presentation on different types of vehicles to save as well, just more unique and sort of niche in different ways. But a 529 plan is really just a tax deferred account, similar to like an IRA or a 401k, where you're not paying taxes on any of the earnings of the investments. So it's growing tax deferred, but it's specifically designed for college planning or just higher education. Over the time, things have changed, and now you can even use the money for K through 12. So it's starting to eliminate some of the other types of 529 plans, or really the unique benefits that those used to have. And we'll cover that a little bit further. Here's another sort of unique situation is between prepaid tuition plans and 529 savings plans. We generally recommend just the 529 savings plan versus a prepaid plan, but it is still an option. In a prepaid plan, it acts similar to how it sounds, is that you're basically purchasing credits at today's dollars for college expense. So college is increasing every year more than inflation by a substantial amount. So you can buy these credits in a way at today's dollars. That sounds great and sounds like it would beat out a college 529 savings plan, because it's a sort of guaranteeing your enrollment. However, there's downsides to that. You don't have the flexibility of a 529 of being able to go to really whatever school you'd like. It has to be that state that you reside in, and that college university that is not a private university. So it's really limits your options. I mean, just in the 10 years that I've been an advisor, I've had clients that they save all this money. The kid should go to an in-state school like UNH, and they're like, Dad, Mom, I want to go to Alabama. Well, it's going to be a lot more expensive now that it's out of state. And if you did one of these prepaid tuition plans, you lose that guaranteed benefit that the college is going to be paid for by what you put in it. Whereas a 529, you control the investments. There's more flexibility on where to go. They both have tax deferral, which is great. The 529, though, you're taking on, in a way, the investment risk, whereas the prepaid tuition, it's the state. Like I said earlier, you can use college 529s now for K through 12 up to $10,000 per year. There's also the lifetime beneficiary towards student loans too. I mean, that sort of defeats the purpose in a way, in my opinion, but it's good to have, as maybe one of your kids still has college loans left over. You can transfer the beneficiary to them and then pay the student loans off, or at least 10,000 of it. I think one of the biggest things to look into is what state you reside in. So if we have clients that live in New York or Massachusetts, you get a pretty substantial tax deduction for those contributions. If you live in New Hampshire, it doesn't really matter too much because there's no tax deduction. So you can really use whatever state's plan you want. Other states that we may recommend too is depending on if our clients are maybe a doctor, a lawyer, maybe have a higher likelihood of being sued for malpractice or need protection versus creditors and so forth. Alaska has a great plan that has much more protection than other states. As you can see here, we do label that some states do have the protection. So on the right here, we have the different creditors and protection. New Hampshire still has it. It's just Alaska, it's a little bit more in depth, a little more protection. Another benefit of 529s is if your child doesn't use all of it, maybe they get a scholarship, that'd be great, and they don't even need the money. Well, if you have another child or even a grandchild down the road, you can transfer the 529 benefits to them. Or even if you wanted to go back to school, maybe get your master's, you can change the beneficiary to yourself and use the assets there as well. So it's really flexible. Some of the other college saving vehicles aren't nearly as flexible as this. So we get this a lot where clients are like, well, I don't know if my kid's actually going to go to college. Well, maybe they won't, maybe they will. At least you're starting to save now and it's growing tax deferred and it's compounding. Like anything else, the earlier you start saving, the better compounding interest you're going to get over time. This just goes over some hypothetical growth of the power of tax deferral. So the gray is talking about a taxable account where you're going to be hypothetically paying taxes each year in this account. So if you're trading in your own brokerage account, you're going to have some gains that might be long-term, some being short-term. But this is just showing if you were making trades every year, basically the power of tax deferral in the 529 plan versus a taxable account.
And this goes to your point earlier, Luke, about the more you're putting in and also the amount of time it's compounding. You can just see how much this grows to. Someone's doing 300 a month over 18 years.
Exactly. And I mean, college is unfortunately getting more and more expensive each year, and the financial aid's not keeping up with that by any means. As you can see, the cost of tuition is increasing substantially over inflation. Not like it's pretty crazy. And I remember this myself. I've been out of college for 15 years now, but by my freshman year in college compared to my senior year in college, it was a significant difference, over $12,000 a year, I would say, difference from my freshman year versus my senior year. And unfortunately, financial aid, as you can see, is decreasing by more than inflation. So inflation's it's increasing substantially more than inflation on the cost, and the financial aid is decreasing by more than inflation on a general basis. Right now, inflation's a little higher than usual, but on an average, this is substantially higher than inflation on both the up and downside.
Yes, and I was very fortunate. My scholarship was actually a percentage, so it had as you see this dramatic increase, it at least kept up in some portion. But most it's a flat. You receive this dollar amount, and that dollar amount gets eaten away, as you said, just every year from freshman to senior year.
Exactly.
So then I'll jump in here to talk a little bit about how is that financial aid calculated? As Luke had just referenced, it's actually financial aid has been decreasing while the cost of college has been increasing. But I think it's important to talk about how is it calculated, and more importantly, how does the 529 affect this? Are you being responsible? You're saving a lot of money for your kids' college, and that ends up being a detriment to you when it comes to applying for financial aid. Want to make sure when we're working with clients that they're just doing it in the most efficient way possible. So what we have outlined here, and as I said, the slides will be available, so we don't have to try to write all this down as quickly as possible. But it just at a high level, this is how the Department of Education calculates for FAFSA. It is important to note that private schools are able to use their own. So if it's a merit scholarship or a financial scholarship offered by the college and needs-based, they can calculate it in a different way. but a lot of financial aid for colleges is paid from FAFSA. So that's why we're focusing on this. The big things to look at is they calculate based on two groups, the student and the parents. And in all cases, they look at income and assets. And for the students, it's the most punitive, if you will. So when a child is applying and the parents are applying for FAFSA, 50% of the student's income is calculated when they're looking at how much need should we be giving. So the more income a student has, the less need they may qualify for, and 20% of students' assets. So later we're going to briefly touch upon gifting to students outside of 529s using things like a UGMA or UTMA, which is essentially a custodial gift to them. That falls in under the student's assets, not the parents'. On the other end is they're looking at the parents' income, and it depends what types of income. That's why it's giving a range of 22 to 47%. More often than not, it's on the lower end of that scale. And then looking at 5.64% of the parents' assets. And this does include 529s. So as parents build up their 529s, it could actually affect how much they receive in FAFSA payments. So one of the things we've been doing for years is actually talking about the grandparents opening up a 529 and funding it. As you can see here on it shows that the college, FAFSA does not calculate based on how much money has the grandparents saved in a 529. So we talk about having the grandparents own it. Now, one of the things you would run into just on a practical level is the grandparent would pay for freshman or sophomore year, and the school would say, "We've seen all your numbers. Where did this $30,000 come from?" And then they would actually start to calculate it, and either you have to tell them that there's money set aside, and oftentimes they would count it as a student's income, which again, 50% of the money was paid would now become punitive. It would reduce financial aid, or they would count it as a student asset, and again, it would still reduce financial aid. There's a new rule that will go into effect on October 1st of this year that will effectively make it so for FAFSA's purposes, they cannot calculate any of the 529 distributions paid from the grandparents. So it would be something where it just makes it even more powerful for the grandparents to own the 529. So that's something we've started recommending more to clients. The exception has been more administratively. Sometimes family don't like to gift, wife's family may not want to gift to a 529 controlled by the husband's parents. Rather, they want something that be controlled by their own family. So sometimes there can be some conflict there, but the best technical option now is for grandparents to own and fund the 529s. So this just talks a little bit more. So when people look at the slides, you get some more details there. Wanted to touch on this part as well, just showing the extraordinary costs of college and different distinctions. Is it a public or a private 2-year or 4-year college? And on this list, it's showing what are some of the expenses. And so, for instance, the tuition fees, room and board, and books and supplies are all things that can be covered by 529s, and those are the biggest parts of these bar charts. But you also see some transportation and other expenses. Typically, those are not covered by 529. So oftentimes we will also talk about keep setting aside a savings account or some other funds outside of a 529, just a smaller portion to pay for these. So Luke's previous example, you live in New Hampshire and your child says they want to go to school in Alabama. If you're paying for flights or for gas, back and forth visits, all those sort of things would not be covered from the 529. So this is just one other thing that's very important. It's the difference between expectations and reality. And as we can see here, over time, as college has gotten more expensive and financial aid has gone down, on the right, you'll see that the difference is being made up from parents and from family. So either cash flow or savings. And so, we've seen some people where they're so bound and determined to pay for college, they've reduced their own retirement savings to make up for that difference. You can also see the expectation, and this comes from how things used to be was that, about 40% of college would be paid for from grants or scholarship or from gifts. The student or parents would only pay 22% or from loans, and then the rest would come from existing income and investments. And you can see here 17% more than anticipated is coming from income and investments. And that will only continue to grow. The important thing is if you have to make up 17% difference, that's where the 529 comes in. It comes in to say, well, what's the most tax and investment efficient way to save?
So inside the 529 plan, there are different investment options. The age-based portfolios are just like the 401k investments that you have options to, those target date funds that might say target date 2025, meaning you plan on retiring roughly around the year 2025. And how those funds work is that it starts very aggressive on the years before that. Say you started that fund in 2000, it's going to be mainly stocks. And as you get closer and closer to 2025, it will just cut some of the stock allocation, put it more to bonds and cash. It will never just all be in cash, but it will become more conservative. And then at 2025, it's not like it's a CD where it matures. It's just might be about a 50-50 split of stocks and bonds, maybe even a little bit more conservative as each year goes on by that year. The age-based portfolios are just like that. It's just that it's going to be dated based on when the child's going to be entering college. So it'll be more aggressive when they're very young and become more conservative once they get closer to college age. The static portfolios gives you a little bit more freedom of what to invest in. So if you're a more aggressive investor and your child's very young, maybe you want to just own like a blue chip growth fund, a very aggressive all stock portfolio. But you have to remember that this is on you on choosing when that you want to de-risk in a way. So if you're going to be all growth and then your child's 16, 17 years old, now maybe it's time that you switch the allocation to be a little bit more conservative at that point. So it does give you the option. Some of our clients are very risk on, some are very conservative. So it really, this gives you that option. Do you want to be very conservative? I mean, we would suggest you be more aggressive. As you can see, the cost of college is ever increasing. But this does give you that option. Like I brought up earlier, there are different investment vehicles or account types for education planning. I mean, the 529, it seems every few years is just gaining more and more additional benefits than it already has. Whereas the UGMA, UTMA, and Goverdell's, they are not really losing any of the benefits. It's just that they're not really evolving like the 529, as they've sort of kept the same amounts that they've had and the same benefits that they've had. So when it comes to, if you really want to have an account for college planning, there's really no other option other than a 529 compared with the two. The only real difference for a Coverdell, I mean, you're going to first of all not be able to contribute as much, and you don't have full control like a 529. I believe at age 30 the money has to be withdrawn at that point or transferred to a different child. The max contribution is going to be lower. The impact on financial aid is about the same, so there's no difference there. Mm-hmm. There's the income restrictions as well. One benefit I could see, but since you can't put as much in it, it doesn't, in my opinion, matter too much, is that you can use the Coverdell for K-12 expenses, but you can with 529s up to 10,000 per year now too. Coverdells don't have that restriction on how much you can use for the K-12, but at the same time, if you're only allowed to put 2,000 a year in, most likely you're going to be able to withdraw more from the 529 over time anyways for that. The big difference for a UGMA, UTMA, where we'll still see some benefit, is that you don't have to use this account strictly for qualified educational expenses. It can be really for a car for your child if you'd like. You still get some federal tax benefit, but the money doesn't grow completely tax deferred or even tax free like a 529. So you do get some tax benefit there. And it does allow you to use it for other things. It does have to benefit the child though. and you can't change the beneficiary on this to someone else. So when that child is the age of majority, generally it's 18 or 21, depending on the state, they get full access to the account at that point. 529, you retain ownership. You can choose to change the beneficiary, say if one of your children don't go to college. So it just gives you much more control, flexibility, and better tax benefits if you know what you're going to be using the assets for.
Two other options that, were really never designed to be education savings. So that's, unlike the Coverdale and the UTMA, but have become such a vehicle are Roth IRAs and variable universal life policies. Now, these are candidly ones that we very rarely recommend for these situations, but they tend to be some where if a client is nervous about a 529 because the assets would be something that are for education expenses. And as we said earlier, what if your child doesn't go to college or gets a full scholarship or any other hesitancies around it? Then these are some alternatives for them. A Roth IRA is the R in IRA is retirement, so it is meant to be a retirement account. And so most of its tax benefits are focused on that. So just like a 529 has substantial tax benefits, whether it be deduction from the state or just tax deferred or even tax-free growth for college, a Roth IRA is designed for retirement, but you are able to access the funds before retirement, particularly all the money that you've contributed. You could take that back out tax-free and penalty-free. And there are some other tax-free or at least penalty-free withdrawals that are allowed for qualified education expenses. So it is something where if someone has been contributing to a Roth IRA for years and it's an account that's really ballooned and they come into a situation where they need to use money for education, this is a good place to dip into. It can also be something where if you're just, don't have the cash flow or the confidence to invest in a 529 and a Roth, investing in the Roth first, again, it can ultimately use for your retirement, but if needed, can help for some education expenses. One thing that I know Luke likes to say, and it's a good one, is you can't get loans for retirement, but you can for education. So that's our other hesitancy can be when people take money out of the Roth to pay for education expenses. But it is certainly an option and something we can go over. The other option that we've seen is variable universal life policies. And these are where you would essentially buy life insurance, but these are a cash value policy. So often you put more money in than the actual costs of the life insurance, and you allow that to be invested and over the long term to grow. And just like a 529 or a Roth or 529 in a traditional IRA, it grows tax deferred. You can take out whatever you've put in on a tax-free basis. And you can even take loans out from there to avoid paying taxes at that time. So I've seen people do this as well, where it was more of a cash flow. They needed life insurance. They were in a high bracket and wanted to defer, but weren't sure if they wanted to use the money for education. Some of the ways it's been looked at as well is, well, I want to make sure education's paid for no matter what. Right now I'm only able to save a certain amount. And so if something happened to me, I would not be able to fully pay. So by having the life insurance policies, you would be able to, if you pass away before fully funding college, the death benefit would be available to your children to pay for college. Or the more hopeful and way we like to use these is at the time you're alive and able to withdraw or take loans to pay for college. Some of the, just one of the main drawbacks with paying for this is it does have the life insurance benefit, but you pay for that too. So it's just a little bit more expensive than it would be for a 529 because it's really covering two needs. It's covering education as well as life insurance. There are also some additional benefits that have grown for estate planning. So right now, there's really a limit of about $17,000 per year per beneficiary to a 529. But you are allowed to just make one large lump sum payment, and then you would file a tax form saying that that is worth 5 years worth of payment. So on this example here, instead of 17,000 a year, you could do 85,000 up front, and that would not be a taxable gift or go against your annual exclusions because you are counting it as 5 years worth. So, oftentimes when we're seeing something like this, it tends to be, again, a grandparent or parent that is trying to move money out of their estate and avoid estate taxes. Right now, and actually there'll be a later slide, I'll go into more numbers, but right now, if Congress does nothing, which Congress is decent at doing, the estate tax limits will drop be cut roughly in half, which will bring a lot more people at risk of having to pay estate tax. But even if nothing does change, certain states have their own estate tax, and up here in New Hampshire, we have the border state of Massachusetts, who has its own estate tax, I believe, at assets over $1 million. And the way housing prices have been, if you own a house in Massachusetts, you're most of the way to your $1 million limit there. So moving money into a 529 takes it out of your taxable estate. So that is something to talk to your accountant about as well. I'm not a CPA, but it is a strategy that we've utilized with clients and their accountants. Right now, the numbers are $12.92 million. So if your estate is worth less than that, you don't have to worry about a federal estate tax, but that number is set to drop to 6.2 million. So it does just bring more people with significant assets under the estate tax numbers, and they may want to try to move money away. One of the most interesting I've seen, I was at a event that was talking about a case where a couple owned a apartment building, and it was a multi-million-dollar apartment building. And to get it out of their state, they had about 10 grandkids. And so they did that annual exclusion for the 5 years, and they gave each of the children about $80,000 into a 529 for each of the grandchildren. And were able to, in that case, can move about $800,000 out of their state in one go. But the other benefit to a 529, which you don't really have with anything else, is you still control it. You can change the beneficiaries. There's a lot of different options there. So they didn't lose 800,000. They just moved it into a 529 and were able to retain control of that asset and keep it out of their estate. One of the other more recent and powerful updates with 529 is, as Luke and I have alluded to, there's always a concern that what if I have too much money left in here? And just with the way that tuition is going, it's rare that you see that. But if that's the case, the IRS has made a new ruling that if several caveats are met, you can move up to $35,000 per beneficiary from a 529 to a Roth IRA. So if you end up, your kids graduate college or your grandkids, and you still have money left in a 529, you could help them fund a Roth IRA using the 529. As I said, there are some caveats. The 529 has to have been open for 15 years. Of the 35, none of those could come from contributions made in the last 5 years. So that's oftentimes avoided if you stop contributing when they go to school. There's the first 4. There are also some limits to what is their earned income, up to $6,500 for those under 50 to contribute. So it could take several years to max out at the 35,000. One other thing to note here is there has not been some clarity yet, where Luke had mentioned you are able to move as a tax-free exchange of assets from one beneficiary to another beneficiary, as long as it stays in a 529. But that change may trigger a new 15-year clock when it comes to this rule. So we're still waiting for some updates from the IRS on that, and just caution clients at the moment to be aware of this if they do make any of those changes between children or grandchildren. But another thing that I've seen where people have had money left is I've had some clients Want to make sure their kids had some skin in the game. So their goal was to always pay for college, but they make their children get $10,000 loans. And if their children do well in college, when they graduate, they'll use 10,000 from the 529 to pay it off. If they don't, then the kid has a $10,000 loan they've got to deal with. So I've seen some of that done as well with excess funds. Luke and I are happy to talk about the more specific situations that anyone may have, whether it be for themselves or their grandchildren, because this is a very powerful tool, but it should be used appropriately, and everyone's a little different. Luke, is there anything too that you'd want to mention on there, or if we feel we've covered it all?
I think we covered a lot. I mean, there's always going to be little changes here and there in unique situations. So whenever those come up, I would definitely let us know. One thing that I'll say that I get asked or emailed every single year is my kid lives off campus, but I need the help pay for their groceries. Can I use my 529 assets for it? Short answer is yes, you can. There's a little bit more to that. I mean, you need to contact the college to see what their food plan budget is. So if you had like a cafeteria plan with them, say it's $3,000 a semester, I have no idea what it would be. Every college is different. Then you could use 529 assets up to that. Anything over that would no longer be a qualified expense. So those types of questions, just give us a call, email us. We get them all the time, but we can't put every little scenario in a slideshow, or else this would take much longer than a half an hour.
Yes, that's absolutely true. There's a lot of fascinating strategies too, where people can own apartment buildings outside of colleges and actually rent to their own kids, pay for it from the 529 and such. But again, there are nuances and so many scenarios. So happy to talk about those. But for now, I think we'll leave it at that. So thank you everyone who attended, and look forward to doing some more of these. Thank you, Luke, for joining us.
Thank you.
Bye.